Is the stock market experiencing a classic melt-up? Meaning, are we way overbought? Absolutely, but we might have some legs left in this market. Lots to discuss. Sit back, let's go. Hello, this is Michael Loftus with Wealth and Wisdom TV, where education is the key to a successful financial future. First time here, I'm a practicing financial advisor. What you see here, we do apply to our portfolios and client portfolios. So please do consider subscribing, smashing that like button. So, are we experiencing a classic melt up? Absolutely, when you look at some of the facts. Now, all that being said, I think we have a little bit left to run here. We're going to show you why in a second. All right, so today's agenda, as always, we're going to take a look at those cycles. Any changes? We'll see. The big charts, what do those signals look like? Sector, spotlight, what keeps me up at night, and game plan going forward. Let's head over to the cycles. For those who have been here before, and of course our clients, part of our process is the cycles. We follow them very closely. We have been solidly in cycle 2 now since about November. Growth accelerates, obviously coming off a low base. Inflation accelerates, absolutely, we're going to show that. Fed is very hawkish, of course. So we start there and then we go to our chart. So let's take a look at the signals right now. All right, so our first chart is a long-term view, which is your monthly view. When you see this, right, this is going back to 2014. There's your trend line, major breakout, relative strength. There is nothing there that looks bad. Clearly, we're in a long-term bullish trend line. Next up, let's take a look at the weekly view. Same thing, right? Has anything changed? Absolutely not. Now, here's our trend line again from 14-15. You can see the trend line, obviously. Big breakout. Now, is there anything that concerns me here? Up here is relative strength, getting a little bit overbought. Not surprising after a big breakout like that. But we are still definitively positive on the midterm. Now, on the daily, so the daily I utilize for whether I'm going in, going out, looking at trends, okay? Now, when you look at the daily chart, it's pretty easy to see a couple different things. So here you see we've got the lower channel and the upper channel, and it goes all the way up. Kind of messed around there for a little bit, came back in, okay, which is very bullish, new device here, getting used to it. But what's happened is this. Okay, relative strength. When you're above 70 on relative strength, it means you're overbought. It's not uncommon to see a pause or a pullback, and that is what I think we're facing right now. So, short term, yes, still definitely in the bullish case. Another reason down here is the VIX, the volatility index. You know, yesterday we went up to 17, but really 15 to 20 is a sweet spot. Got to be patient here. I think this is an opportunity to buy the dip. Let's see how this plays out. But I still say, obviously, we're still positive in this trend. Now, let's go to sector spotlight. All right, so one of the things with the cycles, and it comes to sectors, with the cycle we're in, you're going to see the dollar starting to crash, okay? Now, in our last video, we felt as we were going up, we thought that was really just a counter trend move, nothing. And as you see, in fact, we have gone to the downside again on the dollar. So if you get the dollar right, you get a lot of other things right as well. So number one is commodities in general. You can look at the CRB index, anything out there. I'm going to focus on oil. What do we see, right? Obviously, we have the uptrend here, okay? And then when the dollar went up, okay, oil went down. So we feel that next move for oil is going to be the upside, especially as it pertains to the dollar. Now, as you can see, going in, going out, let me be clear. There are tax ramifications on that. If you're not in an IRA, we have some disclosures on the back end. So the other thing that I look for when it comes to oil is oil volatility. We're down here at 35, a little bit high. I'd like to see it below 35. I would anticipate that today based on futures. Recording this Tuesday about 9 o'clock on the 20th. So next up, okay, are banks. Now, we are showing indexes here. Again, disclosures at the end. You can't buy what I'm showing you. We, of course, buy ETFs and individual stocks. Have to set an appointment, or, of course, our clients know. So what are we looking at here? A couple things, okay? So why is the bank sector going up? Because rising interest rates. Same thing. We had a counter trend move as it pertains to rates. I'll show that in a second. All right, so we had a really nice run, and then what happened? Another consolidation. Not surprising, right? Because here, okay, relative strength, we got overbought. This is what the market does. It'll get overbought. You either see a consolidation, which is a good thing, or it'll go down. Obviously, that then shows that the trend is changing. Don't see that here. Now, in the gray, that's our momentum, what's called MACD, okay? As you can see, it's going higher, 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 okay? That also is a good sign. So we continue to like the overall bank sector as we go forward, and we'll show you a little bit more here in a second when we show the actual 10-year Treasury. So another area I haven't talked about, but here's the EFA, right? The EFA is international, not emerging markets, okay? International, and we've had a nice trend here, okay? Need to delete that, right? Bottomed out, went up, consolidation, and then a move higher. So continue to like the international markets. So think of Germany and London, Norway, et cetera, et cetera. Now, like everything else I'm seeing on the charts right now, getting a little bit overbought. So going to wait and watch that, but continue to like this particular part of the international market. I've talked about this one, hasn't really worked out. I mean, I shouldn't say that. We have had a nice move here. Semiconductors, what's going on? Well, if you're not aware, big time shortage, worldwide shortage, which I think should drive prices up, okay? Now, yesterday we got hit pretty bad, as all tech did on Monday, so right now, I'm not worried about that. I think it's just a short counter trend move. Obviously, we continue to go higher, right? These are higher lows, okay? So overall, I still like semis, but need to see something here. I think it's this part of the market and the next one, which is small caps. Small caps has had a great run and just like semis has stalled out, okay? So these are two sectors we've been in, continue to watch, want to see what's going on. I'm not ready to give up on those sectors quite yet, okay? So the next trade or the next sector I want to talk about is what I call the trash sector. What is that? All those sectors that got hammered, okay, during the recent crisis, okay? So what do I mean by that? Hotels, airlines, cruise lines, okay? So here is the airline index. Again, you can't buy this. The airline index, I do think this is a good place to be, a small position we started. Why? Because everyone has pent-up demand. Everyone wants to get away. I do. You do probably. I think you've seen a nice little move up. Last weekend, we had some of the highest travel in a while, according to TSA. So I think that long-term, again, we got a little bit overbought up here, counter trend move, but I think some of these sectors are worth tiptoeing into, mainly because a lot of upside after being beat up, okay? So the other thing is it's where you're not sometimes in cycle 2. China has gone to cycle 3. Now, we did have a big move yesterday. The question is it enough to change the trend? Don't think so at this point, but you can see here, right, at the high, and then we kind of consolidated down here. They're solidly in cycle 3, kind of ahead of us. So that's an area that we have avoided now and have been at it for some time. So I've talked about treasuries. Let's take a quick look here. Again, another counter trend move similar to what we saw in the US dollar, right? Obviously you bottom out. All of these are lower highs, and then we peaked up about 1.9% on the 10-year treasury. Now, yesterday we did have a nice move to the upside, okay? We still feel this will continue on. Why? Because the bond market is generally smarter than the stock market. Now up here I did a link on, is rising yields bad for the stock market? I mean, the answer is no, but I show some facts, so take a look at that video. So, lots going on here. Now let's go to what keeps me up at night. All right, so what keeps me up at night? The Fed, right? Take a look at what's going on with all this printing. Here is this year. Basically, outlays, right? Money in, money out, okay? As we do a financial plan, same thing. Surplus deficit, $1.7 billion coming in, $3.4 billion going out this year. Now, that does not include the rest of all this printing and all this money going out. So let's take a quick live look at the debt clock. Holy moly, look at that. $28 trillion. So we know we're going to have a $2 trillion roughly deficit this year, plus the $3 trillion plan. This is going to be in the 32 to 33 trillion range by the end of year. It literally is not being addressed, scares the heck out of me. At some point, it has to be taken care of. So let's go back to the rest of the chart. So what's next? Consumer price index is not economic reality. What do I mean by that? CPI, consumer price index, is inflation. Okay, here's something we put out on our social media last week. Links below, always putting out good articles. This is from June 20th. Steel, 145. Lumber, 126%. Oil, 80%. Soybeans, 71%. Let me go on and on, but I won't. I think you get the picture. Hello, inflation. The Fed says no inflation. They're absolutely crazy. Now, see these earnings reports, which have been positive, but what you're hearing from the CEOs is concern about rising costs. Rising cost here, rising wage costs because of a tight market. Going to continue to watch that because obviously that affects what? The bottom line. Earnings will continue to watch. Here's something I don't generally address. What else keeps me up at night? All right, we've got political and geopolitical issues right now that we need to address. I don't look at it from either side of the table. It comes down to where are we and how do we manage money, okay? But at the end of the day, you can't deny there's some stuff going on that has me a little bit concerned because you can manage interest rate risk, the dollar risk, right? I'm showing you how you can take advantage of that. It's difficult to manage political, geopolitical type risk. So, all right, so the last thing I want to address is earnings. We are seeing a big boost in earnings, but right here, the blue line is what's called GAAP earnings, generally accepted accounting principles, standard accounting, right? Obviously, we peaked and we've come down. Not only have we come down, but the market's done what? Gone straight up. Okay, that is a huge disconnect, which also puts us to this. We've seen this before. My favorite, probably your least favorite chart. It shows the S&P, okay? Red is 20 PE, price earnings. Blue is 15, the long-term average. If we were to get back to a 20 PE, 1883, that would be a 54% drop. 66% to get the 14, 12, 15. Again, not saying it's happening, but that shows you how grossly overbought this market is. That market melt up I'm talking about, here it is right there. Look at that line. That is definitively melting up. So what do we do next, right? Be patient, be smart. Is this a buy the dip opportunity? We'll see, right? Got to be selective. Great time to take profits, okay? No one ever went broke taking profits. Be smart, okay? Volume and volatility. As we have stalled here, volume's gone down, volatility's gone up. Those are great signals. Cycle changes, don't see it yet, okay? We'll keep you up to date. And of course, if something does happen, we're gonna announce it on our social media first. Thanks for watching. Michael Loftus, Wealth and Wisdom TV.